out of their busy schedule to be with you here today and actually do tonight's presentation together. First of all, I'd like to welcome Mr. Christian Walter, who is Managing Director of PKF Hotel Experts, as well as Mr. Florian Kollenz, who is Senior Consultant at PKF Hotel Experts. Christian Walter.
Let's work first and then wait with the applause.
So Christian Walter actually started his career in the hospitality industry, doing a number of traineeships, including very famous hotels such as the Brenner's Park Hotel in Baden-Baden. He joined PKF in Munich first. It's an international firm. I'm sure they will tell you a little bit more about it. And then moved to Vienna and moved all the way up to managing director of this consulting company. And he's mainly in charge of operator search for hotels. Florian basically joined PKF in 2008. He also has a history of working in hotels such as the Media Group, which is opening a hotel here in Vienna quite soon. And then he worked for the Austrian Tourism Bank before joining PKF. And he actually just told me that it's going to be his very last project with PKF, this presentation. He is actually joining 25 Hours to be in charge of their development. So he's moving to Hamburg and is going to work for 25 Hours. So it's a great pleasure to have caught him in the very last minute. And I'll hand over right to both of you for your lecture tonight. You've prepared a number of slides and there are a lot of interesting questions. So go right ahead, the floor is yours.
Thank you, Manny, for the very nice introduction. Can you hear me like that? I mean, I have this microphone, but I'm not sure. Can you hear me in the back? Yeah. So welcome to this lecture. Florian and I, we have prepared quite some slides. Actually, we will not have the time to run through all the slides. And we have learned that you have prepared so many questions here. And we really want to give you the opportunity to discuss those questions towards the end of the lecture. So I'd say that we definitely reserve the last quarter of an hour for questions, if that's fine for you. But we want to make this session very interactive. So whenever you want to challenge us, please challenge us. Whenever you have a question, please ask us questions. Yeah? I don't want you to fall asleep. I don't want you to play around on Facebook or whatever. We really try to grasp your attention and run through this. Our topic is hotel project development. Florian and I, as Hani already outlined, we are hotel consultants. We work for a company that is called PKF Hotel Experts that is based here in Vienna, a team of around about 20 hotel consultants. So we only do hotel consulting. We only focus on hotels, hotels, hotels. What are typical services hotel consultants offer? Do you have any clue? What does a hotel consultant do in his or her daily life? Feasibility study. Very important. That's one of our core businesses, yes. Okay. Market research, that's a very important element of a feasibility study, for example. Other ideas? Maybe if you look at this opening slide here. Operator search, for example. Any idea what is operator search? What is operator search? Operator search.
Maybe when you are creating a hotel and then you ask for a big brands to come in and to operate the hotel for themselves.
Okay, yes, very good. So basically there's a developer developing a hotel, building a hotel, investing money into a hotel, but those people owning hotels, investing their money into hotels, do they also manage hotels? Do they also run hotels? Sometimes, okay, they're owner-operated hotels, that's true. But most of the time, we have a lease agreement or a management agreement or maybe a franchise agreement. Yeah? So usually there's one party owning the hotel, owning the real estate, and there's one party operating the hotel business that is accommodated in this piece of real estate. And those people are usually our clients. So most of the time we work for hotel investors, for hotel developers. So operator search is actually one of our core businesses, and Florian and I, we're both working in the field of operator search. What else is there? Financing, corporate finance, that's also part of our business. Sourcing debt, sourcing equity for hotel developments. And that's what we want to focus on. Brief introduction, I think that's all we want to say about us. If you have questions about us, about our profile, we can do that a bit later. We want to briefly touch upon operator search and selection. How do we approach this? How do we search for an operator for a hotel? How does that work? A bit of an overview of hotel groups and brands. I don't think we have to focus on that one too much, because I guess you're all hotel professionals, so you have a pretty good overview of the hotel industry. Lease management franchise agreements. That's also something we want to focus on. Then we have a little case study for you. We will run through about a quarter of an hour and Q&A session in the end. And there are 2 slides we want to use to warm up, which are there to help you understand or help us understand what are the peculiarities of hotel real estate, of hotel properties. There are some pros, there are some cons. So why would people invest their money into hotels, into hotel developments? Or the other question, why should they rather abstain maybe from a hotel investment? And as you can see on this first slide, what is your first impression? Is that rather the slide with the pros or with the cons? It's rather negative, huh? So let's just run through those bullet points and let's make this interactive here. So let's start with the first one. Limited fungibility, third party usability. What does that mean? Can anyone explain?
As a hotel, the building can only be used as a hotel.
Yes?
No office building, shops or something else in there. The hotel can only be a hotel.
Okay, that's very important. A hotel is a hotel is a hotel. So once you've built a hotel, it is difficult to convert it into some other use.
Actually, it's even more than that. Hotel is not only a hotel, but you often also develop it for one specific operator. Like the example, 25 hours is very unique. Let's say in its interior design, you wouldn't find another operator running the same hotel with the same kind of furniture or interiors or finishings. So you have really a specific design-oriented approach that you cannot use for other groups. So it's not only that it's the hotel usage, but you're also limited to a certain extent in terms of the operator who can run the hotel.
Yeah, so that's basically the second element too. That's third-party usability. So if you build an EBIS, it's difficult to switch into any other brand. But why is it so difficult to convert an existing hotel into something else, into any other use? What do you think? Why? Why is it so difficult in terms of investment?
Well, when you have a brand and then you design it and you have logos and everything, and people know it, are supposed to know it when they walk into the hotel. So if another brand comes in, they don't want that to happen. You think that is
Okay, that's more about the branding, the branding, the operator side. But just if you think about the building itself, a hotel building, why is it not so easy maybe to make it an office building suddenly?
Maybe if you think about all the bathrooms they built.
For example, yeah. Just think about the structure of a hotel. You have guest rooms, you have maybe 200, 250 guest rooms. Each hotel room has a bathroom. It doesn't really make sense just to convert this into an office building. Maybe you can think about an apartment, residential use, then maybe the rooms are too small.
You also have certain requirements with regard to the room heights. So we had this example in Warsaw, a project where we worked for a developer. We actually wanted to convert an existing structure into an office building because it would have been, well, the most attractive investment, but they were not allowed because they needed a certain room height, which basically meant that they had to demolish the existing structure and build something new. So they looked into hotel usage and it was meant to be a hotel. So also there you have certain requirements which you specifically need to look into.
Large capital commitment. Why large capital commitment? Also again, if you try to compare it with other sorts of real estate. If you compare it with an office building or maybe with a residential building, Why is it such a large... Do we have to be in the camera all the time? Why is it such a large capital commitment?
Well, because you obviously need a lot more money for a hotel because there's a lot more details you need. I mean, if you build 20 rooms, you need 20 bathrooms. If you build an office, you can build 5 offices and 1 bathroom.
Exactly. So you have one guest room that is fully equipped, and then you have to multiply it times 100, 150, 200, 300, whatever. So there's a flat screen TV in each and every guest room. So that's a very
Maybe a
large
question.
commitment.
What would you assume is the investment for a 5-star luxury hotel only for the FF&E? So only for the furniture, fixtures and equipment per room? Per room.
5,000.
100,000? 50,000? 300,000? So 100,000 was quite good. So in the range of 80 to 120,000 per room. That would be the FF&E investment budget, let's say, for something like
So
4
FF&E
seasons.
is clear. FF&E, short for furniture, fixtures, equipment. Okay. So it's basically all this that is in a hotel room, in a hotel.
So if you
Including
turn
also the
around
public
it-
areas.
Yeah, if you turn around the hotel, so everything that falls out is FF&E. Easy to understand.
But now we've only touched on the FF&E. So the total investment, any idea? Let's stay with a luxury hotel, 4 seasons. What would a 4-season cost as an investment per room to construct it, including the FF&E, everything, approximately? 300,000. That would be a very, very simple 4 seasons. Probably rather be a Hilton or a Marriott or something like that. I mean, let's put it like that. Anything is possible. And it usually starts at around 500,000, 600,000. But you can also easily spend 1 million or 2 million if you want. Yeah. So there are no limits to the investment. Long ramp-up phase for new hotels. What is that? Also compare it to other real estate uses again. Compare it, for example, to an office building. Why did we put this here? Long ramp-up phase.
It might take a while until it gets the money back in. That's possible to put into it because I mean, in the office you start work right away and you have to do it in the hotel to get the guests.
Yes, yeah, it's sort of about the amortization, but if you look at the cash flows, so the return on your investment. What is the return on your investment if you look at a hotel? Let's assume there's a management agreement. Yeah, so you own the business, you have a management agreement. When is there a ramp-up phase? Why? What is typical for a hotel? If you look at the performance of a hotel, a brand new hotel. Okay, it takes a few years. That's it. Yeah? If you have an office building and it's 100% rented out, even before you completed the building, you still might have some grace period or whatever, so they might not kick in at 100% of the lease or the rent right from the first day, but still you will stabilize your cash flows pretty much from the beginning. If you have a management agreement and you basically own your own hotel business, it takes a while. What is the ramp-up phase typically for a hotel? So how long does it take until the hotel performance reaches more or less a stabilized level? 1 year?
5 or 5.
So the answer that is always correct is, of course, it depends. Of course, it depends. I'd say it's probably anything between 2 and 5 years. So usually, if we do a feasibility study, we include a financial forecast. Usually, the hotels stabilize in the 4th operating year. But it very much depends on the market. In Vienna, for example, in terms of occupancy, you might stabilize your hotel pretty quickly. In other markets, it might take longer.
Especially in markets where you have high barriers of entry. As an example, Zurich. It's very difficult to find plots in Zurich city center or also office buildings for conversions. There you would have probably only a ramp up of 1.5 or maximum 2 years because there's basically nothing in the pipeline really in the city center. So it really depends on the market how long the ramp up would take. If it's a new destination, we've also been working in Nigeria this year in Abuja. There you're basically talking about new destination, new city parts, and there we assumed ramp-up phases of 6, 7, maybe 8 years, because you are developing an entire new part of a city. So it really also takes the time for the hotel to have a ramp-up. I also wanted to get back to the point you mentioned that I mean, for office buildings you have a certain vacancy rate in the very beginning, but which is rather low. But it depends for the hotel also whether you have a management agreement or a lease agreement. If you have a management agreement, then you're really taking the operational risk and really feeling this ramp-up phase. If you have a lease agreement, you don't have any vacancy because you have one user and who is paying rent from the very beginning. And then you can also get financing for such a project. This was the case now in Vienna, the main railway station. You had many office projects which didn't find office users who were willing to rent those spaces. And that was a reason why the developers weren't able to get financing and get the project off the ground. So many of them looked into hotel real estate and said, well, I only need one user who's giving me a lease contract, and then I can get financing and can get the project off the ground. So it depends also on the operating agreement.
Let's also pick the last one, shorter renewal reinvestment cycles. What does that mean? Maybe the last row wants to participate. I can hear some constant murmuring back there, even without a microphone. What is the last one, the last bullet point? Shorter renewal reinvestment cycles. Yes, please.
Well, I mean, your hotel always needs to look nice and beautiful for guests, so if your bed is worn out, you have to get a new one for the guests. You don't want the guests to stay in a shabby bed just because it's 5 years old. Whereas in an office, you always have the same employees and they're used to their work conditions. Obviously, you also have to change it, but it doesn't always have to be 100% nice.
That's true. I mean, you have to maintain the product. You have to reinvest into the product. You might have to replace mattresses, a table, whatever. But there's also something that is called the zeitgeist, yeah, or taste, style, whatever, lifestyle. So basically, today you are forced to reinvent your product every now and then. What is your guess? What is a typical reinvestment cycle today for a hotel? 20 years? So it works for 20 years, and then after 20 years, we reinvent ourselves? 10 years? 5 years?
I already heard the right answer. It depends.
It depends. It's true, it depends, but the trend generally is it's getting shorter and shorter. Yeah? You have to reinvent yourself. Maybe every 4 years, 5 years, 3 years, I don't know. And again, it depends on the competition, it depends on the market.
Depends on the occupancy rates. If you're running at 90% occupancy, you might have to reinvest into the furniture after 3 to 4 years. If you're running at 45, 50%, well, of course, you can take more time for your reinvestment period.
But just to develop an understanding, what does that mean financially, the reinvestment? There's something we call a FF&E reserve fund. So we put money on the side, on a bank account. We accrue money so that we have funds available if we need to reinvest into our hotel. What do you think? How much money do you have to put into this reserve fund on a yearly basis?
3% of the revenue.
3% of the revenue? Okay. Any other guesses? So there's pretty much something of an industry standards today.
10%.
How much?
10%.
8?
10.
10. Okay. Usually it's 5%. 5% of the total revenue per year. That's quite something. 5%. So 5 cents of every euro you earn in the hotel as a revenue, you have to put aside for reinvestments, but only reinvestments into the FF&E. Only reinvestments into the fixtures, furniture, and equipment. Not the building itself. For the building itself, you have to accrue another reserve fund, and you usually put between 2 and 3% into that. So altogether, yeah, comes close, not really to 10%, but around about 8% of your annual revenue you have to put into those funds to really safeguard that you have the funds available if you need to reinvest into your property. And many, many hoteliers don't do that. They can't afford to do that. Private hoteliers, particularly in Austria, skiing regions, they don't put any money aside, and then after 20 years, they realize, okay, we have to reinvest into our product. It's no longer up to the market, but they never put any money on the bank account. So then they have a serious issue. Right?
Yeah, that's when they approached the Austrian Hotel and Tourism Bank and we had to tell them, no, sorry, where's the equity?
So here we put some pros also of hotel investments. We were struggling a bit to really come up with pros, but there are a few. And I don't really want to go into detail here because we already talked for 25 minutes and we have so many more slides. That's why we would like to go right into the operator search and selection, just to share with you how do we approach operators if we have the assignment from a client to search for one. Maybe Florian, you can focus on the first one.
We have a 3-step approach, which we basically implemented, I think, about 10 years ago, or even before that. Michael was already doing that in Munich, which is also kind of different to the approach which is used by many brokers. There are many brokers, real estate brokers or consultants / brokers out there who say, well, I will find an operator for your project and then I want to have, let's say, 2 or 3% of the value of this management agreement or of this lease agreement. Well, it's quite easy to find an operator. It's always the question, will it be a good contract at the right terms? Will it be the right operator for this specific project? Or is it probably the wrong operator? So if you want to make revenues as a consultant or broker quickly, you can use this brokerage model and say, well, I will find somebody within the next week, I'll get my 3% and then next project. But the problem is that you probably won't have your clients for a very long time, or they will not come back to you if they're not satisfied. So what we are doing, we have this 3-step approach where we're trying to save costs for our clients. So in the first step, we are telling them, well, we will see whether there's a general interest on the operator's side for this specific project. So what we have done usually first is we have run a feasibility study for the project and come to the conclusion, yes, it's feasible, and now we want to go out and find the right operator. So in the first step, we identify the groups which would be suitable and the brands which would be suitable for this specific project. So we come up with a long list, could be 10 hotel groups, could be 20. Again, it depends. Which location? Is it a city hotel? Which positioning? Is it super luxury? Is it budget? Is it somewhere in the mid-segment? I would say we're also doing quite a lot of resort projects. The lists, or the first list for resort projects, are usually not that long because you don't have that many operators really specialized in running resort hotels, because it's an entirely different business model compared to city hotels. So what we are doing is we are preparing this long list, discussing it with our client, preparing the first fact sheet and a confidentiality agreement where we basically say, well, we're sharing information with you and you're not allowed to tell anybody else. And this is the first approach. What you actually have to do before this first step is ask for something. Ask the client something. What would you assume? What do you have to ask the client first before finding the right operator with the right contract? What do you want?
Investment, how much money?
How much money? What is the investment? Yes. Returns. The kind of results. Very good. Yeah. So it's basically the goals of the investor. Does he want to have a flip around, so just developing the hotel project and selling it? Does he want to keep the real estate for the next 3 generations? So what's the goal? Then also returns. What are the hurdle rates? What kind of returns are they expecting? Are they reasonable? Are they realistic? We have clients who are saying, well, I want to develop this luxury hotel, but I want to have like 8-9% as a yield on average on an annual basis. And then you have to tell them, well, sorry, but that's not going to be possible. So first you really have to ask the client what is the goal, and if it's an exit, so many times we're working for real estate developers who do not want to hold the real estate, then always the question is, what does my exit look like and who am I selling to? And in the German-speaking area, it's still very common that you have a lease agreement that you can sell to institutional investors who are looking for a steady cash flow. So you're looking for a lease agreement, which basically means that you have a fixed cash flow or a revenue-based cash flow, but that you're not taking the operational risk. But we will talk about that later. So actually, before the first step, you have to ask, what is the goal? Are the goals realistic? And then you have to think about the operators. Coming back to the agreement shortly, Hilton, Marriott, Intercontinental, do you think they sign lease agreements? Or rather management or franchise agreements? Yeah, so for most of them, they're tending towards franchise and management, because again, it's a matter of risk they are taking. With a management agreement, they earn certain fees which are dependent on the revenues and the results. For franchise agreement, it's only the revenue that counts. So the risk is way lower for those groups. If I'm not working for an Austrian investor who says, well, I want to sell to an institutional fund, then Hilton, Marriott, Intercontinental, they are probably not the right operators you want to talk to. Or you maybe want to talk to him, but only for a franchise agreement, and you have to find an operator sitting in the middle, taking the operational risk. So again, it depends what is the goal and who do you have to approach. So how does this work in reality? Each of those groups, let's say we have a long list of 20 groups, has a development manager who's in charge of a specific area. Let's assume we have a project in Vienna. So we prepare this factory, prepare a confidentiality agreement, prepare an initial letter, send this out. Then usually what happens? Exactly nothing. So they don't get back to you because they're all busy and have 20 projects they're working on at the same time. So you have to ring them up, try to get a feedback, and then you get the thumb up or thumb down, and then you have a first shortlist. So you might have, out of those 20, let's say 3 hotel groups which are interested. Would you then proceed with the project, or would you say, might not be a good idea? So it's a first indication. If you only have 3 interested parties, then you might reconsider whether it's really a feasible project. If you have 5, 10, or 15 interested parties, then let's go ahead and start with the second step.
That was my last one.
Yeah, sorry, we missed it.
We want to do a little impromptu case study, real life case study, just to make this a bit more down to earth. Let's assume that there is a property, or there are actually 4 buildings on the Ringstraße. You all know the Ringstraße in Vienna, right? Okay. So let's assume there is a block of 4 buildings. The address, I think, is Schubertring 5-7.
Yeah,
I think so. So Schubertring 5-7. Today it says the Ritz-Carlton Vienna. So who knows the Ritz-Carlton Vienna? Most of you. Okay. So let's assume there is a real estate developer, an initial investor, and let's assume that those 4 buildings are not a hotel, they are office buildings, some residential, I think, not sure, let's say office buildings. And someone puts those 4 office buildings on the market. So they put them out for a bid. It's a bidding process. Okay? One of the bidders is our client. It's an Austrian real estate development company. So they come to us and they ask or tell us, okay, we're bidding for those 4 properties, and we think about converting them, first of all, purchasing them, and then converting them into a hotel. Does that make sense? So what do we do? To answer the question, the first service we discussed at the beginning, we prepare a feasibility study. Okay? So we consider whether that's feasible to convert those 4 buildings into a luxury hotel. So we do a feasibility study, a site analysis, market analysis, we give product, concept, positioning recommendations, we prepare a financial forecast. Based on this financial forecast, our client prepares their bid. So they bid, they put a price up for the bid. At the end of the bidding process, there is a decision. The winning bidder is not our client. Our client comes out number 2 of this bidding process. The winning bidder, I think, was a Greek businessman. So the Greek businessman is buying the property. Our client has some indication from the market that maybe this Greek investor who won the bid might actually not be able to close the deal. I mean, it's one thing to win a bid, but in the end you have to deliver, you have to execute, and you have to put the money on the table. Usually there's some time in between the result of the bid and the actual closing of the transaction. So our client decided, based on the rumors they have from the market, that they should continue working on this project. So they just assume that they won the bid and they just keep on developing a hotel project out of those 4 buildings. Okay? It's a bit of a risk. Would you agree? They have no certainty at all, but still they invest some money, and consultants are not cheap. They just paid for the feasibility. Now they decide to start with the operator search, and we start with the first step. How long do we need for the first step? What do you think? So reaching out to the market, and then in the end knowing, okay, out of 30 operators we contacted, 15 are really interested in the project. What do you think? 1 month? That's good. So it's usually between 4 and 6 weeks. How much does it cost? Also that you develop a feeling for the fees consultants charge. Just to give you an example. What do you think? The first step. How much does this cost? How much do we earn as a revenue? Yeah, it depends. In this case, no, because we have a flat fee. It's always the same. Any guesses? Close. 8,000. So we charge 8,000 for this first step. By the way, the feasibility study, any idea how much? 3,000. Okay. So full study, a full feasibility study, anything between 18 and 25,000 euros for 50 pages. That's the price of a feasibility study. Okay? Just to have an idea. So actually the interest was huge. Ringstraße in Vienna, really a very prominent location, great buildings. So we really had a massive interest from international luxury operators, all of them. Four Seasons, Mandarin Oriental, Ritz-Carlton, Shangri-La, Raffles, whatever. Okay, so then we proceeded with the next step. We prepared something we call an info package. So that is a very comprehensive information you send out to the interested operators. What would you put into such an info package? What would you want to share with interested operators? So they signed a confidentiality agreement, they're generally interested in the project. What would you send them? To present the project. What would you want to know as an operator? The location, a few maps, a few pictures. Yes? Franziska?
The number of rooms.
Number of rooms.
Probably, and the rate of the rooms.
The rate of the rooms, that's already an interesting point. Would be, I mean, of course we run a financial forecast when we do our feasibility study. Would you include the financial forecast why or why not?
Data of the city from the start and forecast for the future?
Yeah, you're talking about the market and the forecast, how the market will develop, but I was talking about the forecast for the hotel project. So we would assume it has 207 rooms. After opening, what would be the revenues, what would be the cost structure, what would be the GOP, what would be adjusted net operating income? Would you put that into such an info package?
I have a question. Do they actually read your feasibility study?
They do.
Isn't that already in there? Like, don't you already calculate the average occupancy rate and the average room rate of your competitors to calculate actually the revenue?
Exactly. In our feasibility study, we have a financial forecast, but when we distribute the info package, we only put a part of our feasibility study into the info package. So usually we do not include the financial forecast because we ask the operators to make their own thoughts and provide us with their financial forecast. And then we can see, do we have a different view in the market? If we assume for this property an ADR, so average daily rate net of 380 euro, and then suddenly Four Seasons comes along and says, well, we assume we can do 600. What is the basis for their assumption? Then we can have a little chit chat. Well, where do they come from and on what kind of data do they base their results? So there we want to get a different input from all different operators to see where do they stand and where do they think they can go in terms of rates, in terms of results.
By the way, we will share this presentation with you, of course, after the lecture. But we just finalized it 90 minutes ago. So
We started 90 minutes ago.
yeah, it is? Okay, very good. Very good. So we have this info package. We would also include some architectural drawings. I mean, it's for existing buildings. So an operator might be interested to have a look at the architectural sketches, the plans of the building. Okay? So anyways, we send this out to the operators that are generally interested. They have a look at the documentation, and then what would you do next? So they come up with some questions, you answer the questions, and then it's already there. You try to bring them on site. Yeah? So you tell Four Seasons, okay, if you're really interested, you have to come to Vienna. Let's have an inspection of the property. Let's walk through the property. You will be able to get to know our client, and let's discuss the project face to face. So we invited all the operators to come to Vienna to have a look at the building, and something very interesting happened during this process. What do you think would happen? Let's go back to this case. Schubertling 5-7. Of course, you anticipated already. The Greek investor was not able to close the deal. So the selling party, what were the options now? The deal just collapsed. So the owner actually was Erste Bank, I think. Yeah. The very renowned, reputable Austrian bank was the owner. So what are the options? Start a new bid, yes. New bid means exactly, takes a long time. Time means, okay. So what is the alternative? Go to number 2. That's what happened. So they gave our client a call and said, are you still interested in the property? And our client said, not sure, let me think about it. But in the end, of course, they acquired the property. So in the end, our client had. That's a good question. Actually, I don't think so. But they got the deal, they closed the deal, they purchased the property, and we continued with the operator search. So those operators you've brought on site, Four Seasons, Mandarin Oriental, Ritz-Carlton, whatever, when they're still interested after this site visit, what would you ask them for? So let's assume there are 8 operators that are really, really interested in the project.
How can you evaluate who is the best? What would you ask? What would you ask for?
Maybe ask for the concept and what would they want to buy, and ask them if they're actually able to invest, like if they have the financial.
Good point.
Okay, Okay, the concept, the product, okay.
Any equity where they're willing to take any risk?
Yeah.
What else?
Maybe asking for a letter of interest and what kind of fees and incentive fees they want.
Exactly. So the first LOI or letter of interest, letter of intent, whatever you may want to call it. So the first proposal in which it should basically say what kind of agreement is it? Is it a lease agreement? Is it a management agreement? And you have the key commercial terms. So what are the key commercial terms you would be interested in? Let's assume a management agreement.
Have you ever discussed lease and management agreements before? Yeah? Okay. Some say no. Interesting. Maybe you missed the lecture.
Not everyone. There's a mixture of students here.
Okay.
Some did, some didn't.
Come on. What do you want to know from your partner, potential operator? So let's assume it's a management agreement.
Yes.
His plans, how he wants to run
How he wants to run the hotel? Yes. What else?
structure.
Employees.
I guess how much profit he's wanting, or from a percentage of his profit?
Good point. So we're basically talking about the fees you're asking for. So usually management companies have a basic fee, which is a percentage of total revenues, and they have an incentive fee, which is a percentage of either the gross operating profit or an adjusted gross operating profit, where you deduct from the GOP or gross operating profit still the base fee or the FF&E reserve funds, or even both. So the fee structure, by the way, beside those two fees, there are lots and lots of other fees and reimbursements and hidden costs. But in an LOI, you usually have the major fees. What else?
Does it depend on how when the whole project starts?
Yeah, good point. The timeline, if we're talking about timeline, what else would be interesting? But it's a good point. I mean, does also the operator have the capacity, if the owner wants to open within 1.5 or 2 years, and we're talking about a luxury product here, the capacity to provide the services for the owner to develop this hotel that fast. But let's stick with the timing. What else in terms of timing is interesting?
Maybe how long plans the ramp-up phase
Yeah, also ramp-up phase, but the contract term,
The length of the contract.
the length of the contract. Will it be a contract for 5 years? Will it be a contract for 10 years, 15, 20? What would you assume are luxury hotel groups or hotel groups in general striving for? Short-term or long-term agreements? Long-term. Why?
to change the brand in, for example, if it's 5 years, then from change from intensity to 4 seasons, we build the whole hotel.
And it's all about the money. I mean, if they can have a contract for 60 years, yeah, incentive fees and base fees for 60 years.
But what if you have a management contract and it's for a very long time, and there were a lot of people that wanted this contract, so you went quite low with your fees and you're giving quite a lot to the owner. Wouldn't you like to have a short contract that when it's done, I mean, it's very hard for the owner to kick you out. So you would probably do another contract with you that would be different.
It's a good point. I wouldn't say it's that hard for the owner to kick you out after 20 years. You could have a total repositioning and quite a lot of investment and maybe bring in another operator. But it's definitely a good point if you're, as an operator, in a bad bargaining position. You're willing to go for lower fees, but still you want to have an extended time frame. But from an owner perspective, what does an owner want? Rather short terms or long terms? Long terms. Also, again, it depends what he wants to do with the piece of real estate.
Do you know what the risks and
The Kempinski? Kempinski has a lease. Kempinski is a lease agreement. It's not a management agreement, and Kempinski has 20 years plus extension options at. Christian, help me. It was your contract.
I don't know by heart.
That's his discretion. I think at Kempinski's discretion.
Audience sharing stays in this room, please.
Yeah,
Otherwise
so
we
it's-
need to kill you. So.
So coming back, so for an owner, it depends whether, let's say, the brand adds value to the project. We're just doing also a project for a Qatari investor in Montenegro, and there we're negotiating with Four Seasons. And there you want to have a long contract term because you also have real estate, so residences you can sell. And every buyer of such a residence will ask, well, do I know that this is a Four Seasons residence? For how long is it going to be a Four Seasons residence? And you can tell them, well, 80 years. Don't worry, it's going to be for 80 years. And then, of course, they're more willing to buy if you're saying, well, we have a contract for 15 years, and after that, if Four Seasons is gone and you don't have any other brand, then my real estate investment value goes down like this. So it really depends on the situation, whether the brand adds value to the project or not. As an owner, what you also want is flexibility. We talked about it, there's an initial term and there might be renewal options. What you want is that the renewal options are at your discretion. So you can be the one who's making the call and saying, well, you, the operator, you need to stay in this property for another 20 years. Of course, the operators want it the other way around, so they want to say, well, usually it should be at our discretion.
Maybe we should continue with our case. So we invited all those interested operators to Vienna. They had a site inspection of the property. You asked them for their letters of intent, their term sheets, as we call it, which is basically a summary of the most important commercial terms of a management agreement. So they all submitted their initial offers. Then you start negotiating the offers. It's a bit like on a bazaar, you know. They all know that there are several parties, so you negotiate and you improve the terms. And then at the end of the day, you do something like shortlisting. What does it mean, shortlisting? Shortlisting, basically, you reduce the number of players in the process, then you do another round of negotiations, and then in the end, you decide for the preferred operator. So the one operator you really want to enter into an agreement, yeah? And you sign a letter of intent, yeah, that includes the most important commercial terms of the eventual management agreement. It's not yet the management agreement, it's sort of a pre-agreement. Yeah? And going back to our case, the client decided, also with our support, for the preferred operator. So who was at that time, many, many years ago, the preferred operator?
Oh,
No, it was
Ritz-Carlton.
Ritz-Carlton. So Ritz-Carlton was the preferred operator, and our client intended to sign the letter of intent with Marriott, with Ritz-Carlton. Then something happened, which is not very reasonable, but it just happened. So an old friend of our boss came to Vienna for a short trip, 2 or 3 days. Our boss and that guy, they had a walk along the Ringstraße, and then the guy said, oh, wow, those properties there, that would be a great hotel. And our boss was like, yeah, it's actually one of the projects we're working on, and it's going to be converted into a luxury hotel. And the guy asked, okay, is there still an opportunity to get into the process? Little information we have to add here. The guy used to work as a development manager for Shangri-La at that time. Shangri-La was not part yet of that process. So for some reason, Shangri-La was not included in the operator search, because at that time they had no presence at all in Europe. So the client said, now let's not put Shangri-La on the list. But there was this guy, and our boss said, okay, I might be able to get you into the process. What you have to do, you have to send me a letter of intent by the end of the